Hey there. Welcome to your deep dive into The Intelligent Investor by Benjamin Graham.
You're joining us because you're ready to unlock the secrets of this investing classic.
And let me tell you, this book is practically a Wall Street rite of passage for a reason.
We're talking about timeless wisdom that's helped generations of investors build wealth.
You know, it's funny. Graham's ideas are almost like a secret handshake among successful investors.
He published this back in 1949, but in today's world of chaotic markets and information overload.
His insights are more relevant than ever.
Okay, so we're diving into the mind of Benjamin Graham.
This is a guy who lived and breathed the markets, saw it all booms, busts, the works.
And he came out the other side with this incredibly clear-eyed approach to investing.
Right, and it's all about tuning out the noise.
Because let's face it, the financial world can feel like a casino sometimes.
Everyone's trying to sell you the next big thing, get you caught up in the frenzy.
But Graham cuts through all of that.
So he's like the voice of reason in a room full of hype machines.
But what I love is how he doesn't make you feel like you need a PhD in finance to get it.
He talks about this idea of the intelligent investor.
And honestly, when I first heard that, I thought, okay, what's my IQ got to be to even play this game?
I think we've all been there.
It sounds intimidating, right?
But Graham flips the script on that completely.
He's saying, look, Wall Street wants you to think this is some exclusive club for financial whizzes.
But in reality, the biggest edge you can have is mastering your own psychology.
So it's less about being a genius
Yeah.
and more about being, what's the word? Level-headed.
Exactly.
It's about being the calm in the center of the storm, not trying to predict every gust of wind.
Think about it. How many times have we seen people make impulsive investment decisions based on fear or greed?
Those emotions lead to buying high and selling low, the opposite of what you want.
And Graham is all about avoiding those emotional roller coasters, right?
He wants you to be this steady, disciplined investor who's in it for the long haul.
Absolutely, because that's how you build lasting wealth.
It's not about chasing quick profits or timing the market perfectly.
It's about making sound decisions based on a deep understanding of a company's value.
And that's where this famous quote of his comes in.
People who invest make money for themselves. People who speculate make money for their brokers.
Mic drop moment right there.
Right. It's such a simple statement, but it cuts right to the heart of his philosophy.
He's drawing a clear line between investing and speculating.
And he wants you to be on the right side of that line, the side where you're building wealth, not gambling it away.
So how do we actually put that into practice?
How do we make sure we're investing, not speculating in our own portfolios?
That's where things get really interesting.
Because Graham gives us this amazing framework for understanding the market.
And it all starts with this character he created, Mr. Market.
Have you ever heard of him?
Oh yeah, Mr. Market is like a legend in the investing world.
But I'll admit, when I first read about him, I thought it was a bit whimsical.
Like we're going to personify the stock market now.
It sounds strange at first, but trust me, it's brilliant.
Because Mr. Market represents the emotional side of the market, the part that's driven by fear and greed.
So he's like that friend we all have who's always either euphoric or having a meltdown.
And their investment advice swings wildly depending on their mood that day.
Exactly.
Mr. Market shows up at your door every day offering to buy or sell stocks.
And here's the kicker. His prices are rarely based on logic or reason.
They're driven by whatever mood he happens to be in that day.
He's either irrationally exuberant or completely despondent, and he wants you to get caught up in his drama.
Okay. I'm starting to see why this is so powerful.
Because in real life, the market can feel a lot like that.
Right. Like one minute, everyone's panicking. The next, they're irrationally exuberant.
But it's so easy to get swept up in those emotional waves.
It's incredibly easy. And that's why Graham wants you to be aware of Mr. Market's game.
Because once you see it for what it is, you can choose to play by your own rules.
You don't have to let his mood swings dictate your investment decisions.
You can be the calm, rational investor in the face of his chaos.
So how do we do that?
How do we avoid getting sucked into Mr. Market's emotional roller coaster?
That's where one of Graham's most powerful concepts comes in. The margin of safety.
And this is all about protecting yourself from the downside from Mr. Market's inevitable meltdowns.
Okay, let's unpack this margin of safety idea because I have a feeling it's going to be key.
You got it. This is where the rubber meets the road with Graham.
We're about to go from big picture thinking to actual portfolio building strategies.
And it all starts with understanding that the market doesn't always price things rationally.
Sometimes it undervalues great companies, and that's where the intelligent investor finds their edge. Think of it this way. Imagine you're at a flea market and you spot a beautiful antique watch.
The seller is asking for $100, but you know it's worth at least $500.
That difference, that $400 cushion, is your margin of safety.
Okay, I'm starting to see how this applies to stocks.
So instead of buying a watch, we're buying a piece of a company.
And that margin of safety protects us if the market suddenly decides to undervalue that company.
Exactly. Because Mr. Market is going to have his mood swings, remember.
He might offer you a ridiculously low price for your stock just because he's feeling gloomy that day.
But if you bought with a margin of safety, you can just smile and say, thanks, Mr. Market, but I know what I've got.
That's such a powerful way to think about it.
It's like having this built-in buffer against the market's craziness.
And it all comes down to buying companies for less than they're actually worth.
And that's the heart of value investing, which Graham is considered the father of.
It's about looking beyond the daily stock prices and understanding the true value of a business.
Which sounds great in theory, but how do we actually find these undervalued companies?
How do we separate the hidden gems from the overhyped duds?
That's where Graham's deep dive into financial statements comes in.
He wants you to roll up your sleeves, put on your detective hat, and really understand the businesses you're buying into.
So no more blindly following the crowd or listening to the so-called experts.
It's about becoming our own financial detectives.
Precisely. Because remember, when you buy a stock, you're not just buying a ticker symbol. You're buying a piece of a real company with real assets, real earnings, and real potential.
And to understand that potential, we need to go beyond the headlines and dig into the numbers.
Now, I'll be honest, looking at financial statements can feel a bit intimidating at first.
It's like learning a new language.
It's true, but like any language, once you learn the basics, it opens up a whole new world of understanding.
And Graham provides a roadmap for doing just that.
He teaches you how to analyze balance sheets, income statements, cash flow statements.
All the tools you need to assess a company's financial health and identify those hidden gems.
It's like he's giving us the keys to the castle, right?
He's empowering individual investors to make smart decisions without relying on Wall Street insiders.
Absolutely. And one of the most important things he teaches is how to spot red flags.
Because not every company is worth investing in, no matter how good the sales pitch sounds.
Okay, so let's talk about those red flags. What are some things that should make us hit the brakes and run in the opposite direction?
Well, excessive debt is a big one.
Graham was wary of companies that relied too heavily on borrowed money.
Because if their earnings take a hit, that debt can quickly become a burden.
It's like building a house on a foundation of sand.
Looks good at first, but it won't withstand a storm.
Another red flag is inconsistent earnings.
Graham preferred companies with a track record of steady, predictable profits.
Because that shows they have a sustainable business model, not just a flash in the pan.
So we're looking for companies that are built to last, that can weather those inevitable market storms.
Exactly. And speaking of storms, Graham was a big believer in learning from history.
He wanted investors to understand market cycles, to see how these patterns repeat themselves over time.
Because, as they say, those who don't learn from history are doomed to repeat it.
And in the investing world, that can be a costly mistake.
Precisely. Graham wanted investors to be prepared for those inevitable downturns.
He wanted them to understand that even the best companies can see their stock prices fall in a bear market.
But if you've done your homework and invested with a margin of safety, you'll be in a much better position to weather the storm.
So it's about having that long-term perspective, not panicking when things get bumpy.
And speaking of bumpy rides, Graham shares some pretty incredible case studies in the book.
Companies that soared to great heights, only to come crashing down.
Right. These stories are like cautionary tales, reminding us that even in the stock market, what goes up must come down.
And sometimes it comes crashing down with the force of 1,000 meteors.
I mean, the story of realty equities, that was a wild ride.
It really was.
Here was this real estate investment trust in the 1960s, riding high on a wave of easy money and investor enthusiasm.
They were making big promises about growth and returns, attracting a ton of investors who were chasing those quick profits.
It's a bit like the dot-com bubble, right?
Everyone jumping on the bandwagon without really understanding what they were buying.
Exactly. And just like in the dot-com bubble, those quick profits turned into devastating losses when the market inevitably corrected itself.
So what happened with realty equities?
What were the warning signs that most investors missed?
Well, one red flag was their heavy reliance on debt.
They were using borrowed money to fuel their rapid expansion, which can be risky if your earnings don't keep up.
And their financial statements were, shall we say, less than transparent.
It was difficult to get a clear picture of their true financial health.
Ah, so they were playing a bit fast and loose with the numbers.
That's never a good sign.
And as interest rates started to rise, their debt burden became too much to bear.
The market finally caught on, and their stock price plummeted.
Investors who had bought into the hype were left holding the bag.
It's a classic example of speculation leading to disaster.
They were focused on the short-term excitement of a fast-growing company without paying attention to the fundamentals.
And they paid the price.
And it wasn't just realty equities.
Graham also dives into the AOL-Time Warner merger, another cautionary tale.
Oh yeah, that was a massive deal back in 2000, right at the peak of the dot-com bubble.
Everyone thought AOL was going to take over the world.
They were the darlings of the internet age, but even they couldn't escape the laws of gravity.
So what went wrong?
Was it just a case of the bubble bursting, or were there deeper issues at play?
Well, the merger itself was a sign of the times.
AOL, despite its relatively small size, Time Warner.
It was a case of the market getting swept up in the hype, overlooking the fundamentals.
They say hindsight is 20/20, but it's hard to imagine two companies more mismatched than AOL and Time Warner.
It's like trying to combine oil and water.
And as you might expect, the merger was a disaster.
The promised synergies never materialized. The dot-com bubble burst, and AOL stock price went into freefall.
It's amazing how quickly things can change in the market.
1 minute you're on top of the world, the next you're yesterday's news.
That's why Graham's emphasis on a margin of safety is so crucial.
It's about protecting yourself from those inevitable downturns, from the market's tendency to overreact.
So we need to be prepared for Mr. Market's mood swings, do our homework, and invest with a cushion.
And, maybe most importantly, don't let the fear of missing out lead us to make irrational decisions.
Exactly. It's about tuning out the noise, sticking to your principles, and investing for the long term.
Because as Graham teaches us, time is the intelligent investor's greatest ally.
Okay, so we've talked about the importance of value investing, finding that margin of safety, and avoiding those speculative traps.
But now the big question, how do we actually put this into practice?
How do we build a portfolio that aligns with Graham's principles?
Well, the good news is Graham provides a clear roadmap for that too.
And he actually outlines different approaches for different types of investors.
Because not everyone has the time or the inclination to become a full-time stock analyst, right?
Exactly. He recognizes that investors have different levels of time.
Interest and expertise, so he lays out two main paths, one for the defensive investor and one for the enterprising investor.
Okay, let's start with the defensive investor. What's their game plan?
The defensive investor, as the name suggests, is all about minimizing risk and preserving capital.
They're not looking to spend hours poring over financial statements or trying to time the market perfectly.
They want a simple, effective strategy that they can stick with for the long haul.
Sounds like most of us, right?
Keep it simple. Keep it steady.
Exactly.
So for the defensive investor, Graham recommends a core holding of high-quality bonds and a diversified selection of stocks.
Okay, so we're talking about a classic balanced portfolio.
But he gets pretty specific about those bonds and stocks, doesn't he?
He does, because he wants to minimize risk as much as possible.
For the bond component, he suggests U.S. savings bonds for their safety and guaranteed return.
Or high-grade corporate bonds if you're willing to take on a bit more risk for potentially higher yields.
So a good mix of stability and potential for growth.
And what about the stock side of things?
For stocks, he recommends either investing in a low-cost index fund or carefully selecting a well-diversified mutual fund.
That makes a lot of sense.
Index funds are a great way to track the overall market without having to pick individual stocks.
And mutual funds offer professional management and diversification.
Exactly. And this is where Graham's emphasis on minimizing costs really comes into play.
Because those fees can eat into your returns over time.
So we're looking for low-cost index funds or actively managed funds with a solid track record and reasonable fees.
Exactly. Now for the enterprising investor.
Someone who's willing to roll up their sleeves and do a bit more digging, Graham suggests a more active approach.
Okay, so this is where we get into the nitty-gritty of stock picking.
It is. But even for the enterprising investor, Graham emphasizes the importance of value investing.
He wants you to find those undervalued companies, those hidden gems that the market has overlooked.
And he provides some really interesting strategies for doing that right.
Like looking for bargain issues in special situations?
Exactly.
Bargain issues are companies whose stock price is significantly below their intrinsic value, often due to temporary setbacks or market misperceptions.
So it's like finding a dollar bill on the sidewalk. It's just waiting for someone to snatch it up.
Exactly.
And special situations are unique opportunities like mergers.
acquisitions or spin-offs where there's potential for significant gain due to a specific event.
So it's about finding those pockets of opportunity that most investors might miss.
Precisely. But even with these more active strategies, Graham emphasizes the importance of doing your homework.
Understanding the risks and investing with a margin of safety.
So no matter what type of investor you are, whether you're defensive or enterprising, Graham's principles still apply.
Absolutely. He provides a framework for intelligent investing that stood the test of time.
And at its core, it's about tuning out the noise, thinking for yourself, and making rational decisions based on value, not hype.
It's about remembering that we're not just playing a game of numbers.
We're buying pieces of real businesses with real potential.
And by applying Graham's principles.
By being patient, disciplined, and informed, we can position ourselves to build lasting wealth over the long term.
That's the power of the intelligent investor. It's not just a book, it's a philosophy.
And once you understand that philosophy, it can change the way you think about investing forever.
So if you're ready to take control of your financial future to become a truly intelligent investor,
This book is your guide.
so dive in, explore Graham's wisdom, and discover the timeless principles that have helped generations of investors achieve their financial goals.
And remember, the most important investment you can make is in your own education.
So keep learning, keep exploring, and as always, keep diving deep.